You won't believe what just happened in the banking world. The shocking collapse of Silicon Valley Bank has left many scratching their heads, wondering how it all went down. In today's video, we'll dive deep into the causes, consequences, and questions surrounding this financial disaster. But before we jump in, make sure to hit that like button and subscribe to our channel for more jaw-dropping news and analysis. Silicon Valley Bank, or SVB, was a major player in the banking industry, catering to tech and life sciences companies. In March 2023, the bank experienced a catastrophic failure, marking the second largest bank failure in U.S. history. Today, we'll be exploring the factors that led to SVB's downfall, the implications of the government bailout, and the lessons we can learn to prevent future disasters. So, what caused the collapse of Silicon Valley Bank? Two main vulnerabilities: a high proportion of uninsured deposits and a significant portion of deposits invested in hold-to-maturity (HTM) securities. With a staggering 93.9% of its deposits uninsured, the bank was already walking a tightrope. Moreover, 94.4% of SVB's deposits were invested in illiquid assets like HTM securities and loans. This lack of liquidity left the bank with few options when the tech boom collapsed, and depositors began withdrawing their funds en masse. Things got even worse when the tech boom's decline and a surge in inflation struck simultaneously. In an effort to curb inflation, the U.S. Federal Reserve increased interest rates dramatically, causing the value of SVB's HTM securities to plummet. As a result, tech companies with deposits exceeding the $250,000 insurance limit began to panic and withdrew their uninsured deposits. SVB's inability to meet these withdrawals, coupled with the decline in value of its assets, ultimately led to the bank's insolvency. Hey, just a quick reminder here, please like this video and subscribe to our channel. Your support helps us continue to bring you insightful content like this, and it also boosts our visibility in the YouTube algorithm. Thanks a bunch. In a surprising move, the U.S. Treasury, the Federal Reserve, and the FDIC announced that all depositors in SVB and Signature Bank would be made whole, meaning they would receive their uninsured deposits back. This decision was driven by several factors. 1. Protecting the tech sector. The U.S. government wanted to prevent the bank's problems from spilling over into the tech sector, which could have led to widespread bankruptcies and economic distress. 2. Preventing contagion. The bailout aimed to reassure depositors in other banks that the government would support them, reducing the likelihood of bank runs elsewhere. 3. Addressing moral hazard. By bailing out depositors, the U.S. government essentially removed the upper limit on deposit insurance, potentially encouraging banks to take greater risks with deposits, knowing the government would step in if necessary. 4. Balancing monetary policy and financial stability. With the Fed raising interest rates to combat inflation, traditional methods of stabilizing the banking sector, like reducing interest rates and quantitative easing, were not viable options. The collapse of SVB has also shone a spotlight on the role of deregulation and lobbying in the banking industry. The 2018 rollback of the Dodd-Frank Act allowed banks with assets below $250 billion, like SVB, to avoid stress tests and stringent capital and liquidity requirements. This deregulation, influenced by lobbying from banks such as SVB, enabled the bank to take excessive risks with depositors' money, ultimately contributing to its downfall. Furthermore, the financial and tech industry's campaign contributions and lobbying efforts may have swayed the government's decision to bail out SVB depositors. These political economy factors cannot be overlooked when examining the circumstances surrounding the bank's collapse and the subsequent government intervention. Guys, if you're finding this video informative, please take a moment to hit that like button and subscribe to our channel. It helps us a lot, and it ensures you won't miss any of our future videos. The SVB debacle teaches us several essential lessons about the banking industry and the role of government intervention. 1. Uninsured deposits and illiquid assets. The high proportion of uninsured deposits and the significant investment in illiquid assets, like HTM securities, left SVB vulnerable to collapse. Regulators and banks must take these factors into account when assessing a bank's risk profile and establishing guidelines for prudent management. 2. The need for robust regulation. The rollback of the Dodd-Frank Act and subsequent easing of regulations for banks like SVB created an environment conducive to risk-taking. Strengthening and enforcing regulations that ensure banks maintain adequate capital and liquidity buffers is crucial to prevent future bank failures. 3. Balancing financial stability and monetary policy. the challenge of managing inflation and ensuring financial stability has been highlighted by the SVB collapse. Central banks and policymakers must carefully consider the potential consequences of their actions on both fronts and strive to strike a balance between the two objectives. 4. The influence of lobbying in politics. The role of lobbying in politics in shaping regulatory environments and government responses to financial crises cannot be ignored. Addressing potential distortions caused by these influences is vital to ensure a fair and stable financial system. In conclusion, the collapse of Silicon Valley Bank serves as a stark reminder of the importance of robust regulation, prudent risk management, and the need to maintain a balance between monetary policy and financial stability. As we move forward, it is crucial for banks, regulators, and policymakers to learn from this incident and implement changes that safeguard the financial system from similar crises in the future. Greater transparency in the banking sector, along with efforts to reduce the influence of lobbying in politics and decision-making processes, can help create a more stable and equitable financial landscape. Moreover, financial institutions should be encouraged to diversify their deposit base and asset holdings, reducing their vulnerability to sector-specific shocks and ensuring a more resilient banking system. Finally, the SVB collapse highlights the interconnected nature of the global financial system, emphasizing the need for international cooperation and coordination in the development and enforcement of banking regulations. By working together, governments, regulators, and financial institutions can create a more secure and sustainable financial system that is better prepared to weather future crises and promote long-term economic growth. Before we wrap up, please remember to give this video a thumbs up and subscribe to our channel. It really makes a difference and helps us continue to produce content like this. Thank you so much for your support. That's it for today's deep dive into the shocking collapse of Silicon Valley Bank. We've covered the causes, consequences, and questions surrounding this massive financial event. We hope you found this video both informative and engaging. Remember, understanding events like these can help us be more prepared and make better financial decisions in the future. If you have any thoughts or questions, don't hesitate to drop a comment below. We'd love to hear your insights and start a conversation with you. Once again, don't forget to like this video and subscribe to our channel for more captivating content. Thanks for watching, and we'll see you in the next video. Check out our other videos for more tips.